Well, the inflation rate today at 7.3% was the highest since 1990 and bigger than any forecast. It also puts pressure on the Reserve Bank, as we said, to consider resuming those 0.5% rate rises when it meets next Tuesday. Now, the triggers of inflation are important. Petrol wasn't a factor. Prices actually fell in September there. But household gas, electricity and food, well, they all jumped sharply. It means that the underlying rate, or the trim mean, was at 6.1%, and that's the highest since it was first measured back in 2003. So let's bring in here Jarrod, Chief Economist for the Committee for Economic Development of Australia, or CEDA if you like. Jarrod, thank you so much for your time. Does the budget have a trouble inside it with inflation less than 24 hours before or after the Treasurer delivered it?
Well, I mean, the budget did clearly point out that there was a risk of higher inflation, and they looked at the sensitivity around that of going, a percentage point higher.
So they say that their base case is 7.75% inflation, but they said, worst case scenario, 8.75%. Do the numbers today suggest that the worst case scenario might be more realistic?
Well, I think that we absolutely need to take pause with this and think about that. And certainly, as you suggest, the Reserve Bank will certainly be doing that and looking at, where it wants to position this next rate rise on Tuesday.
OK, can I take you to the trim mean at the bottom? That's the one the Reserve Bank looks at. It strips out all those volatile things like petrol or whatever it might be. But that at 6.1%, when they want that between 2 and 3%, that's way above it, right?
Well, that's exactly right. And what we're seeing in the numbers is, 3/4 of this is driven by goods. A lot of that is about excess demand. And so the Reserve Bank could be looking at that and looking at the fact that we've still got excess demand, which is exactly the thing that they are trying to bring down. So there's some real, stronger messages in here, I think, around the fact that policy is going to be moving both in the budget and in monetary terms.
In hindsight, could have the Reserve Bank got it wrong by raising rates by 1/4% last month when the market was fully expecting a 0.5% rate rise?
Well, that's all in the rearview mirror now, isn't it? But I suspect perhaps if they had their time again, they might want to keep the pace up at 50 basis points. OK,
so then you've got a whole situation that that there's electricity price rises, gas price rises coming. The budget tells us that. And so the point is that there's not really any let-up for inflation in the very short term. This is a potential budget risk, even an economic risk for the government, having delivered this budget.
Well, that's exactly right. And you can see that in the inflation numbers today. We see that for electricity prices, which rose 3.2% in the quarter, if we stripped away those kind of household rebates in WA and other jurisdictions, we actually would have had 15.6% electricity price increases, which is really significant. Then when I look at the budget and I think about those scenarios that they've looked at, and if you get, global storm clouds, darkening, you get this sort of increased inflation above what we were expecting at the peak, and you start to get a really negative feedback loop. You get very cautious consumers and the risk of a hard landing. So that's something that we've got to keep looking at in terms of and what policymakers everywhere are trying to get right is that we don't have the hard landing, that yes, we absolutely need the economy to slow down, but we don't want to overcorrect either. And there's obviously a big lag in terms of interest rates and when we'll start to see that come through.
I'll tell you, it's going to be fascinating to watch this. We'll get you in again very shortly to talk about this. Jarrod from the Committee for Economic Development of Australia, CEDA. Many thanks for your time.
Thanks, Ross.